Well, we're looking for 25 basis points cut from the Fed next week. We think the data solidified that with the payrolls. Clearly, it wasn't definitive. It didn't give us that 100% clue that the Fed is going to go 25 or 50. You did have the weak headline payrolls numbers and 2 months of revisions lower, plus at the same time countering that, the unemployment rate dropped back, and you had average hourly earnings growing at a reasonable pace. So it's not clear that the jobs market is softening rapidly, and we think for us this is still a move towards a soft landing in the US economy. The US consumer seems to be spending reasonably well. Disposable incomes are healthy and holding up. Balance sheets are holding up. So 25 makes sense in September, and then 25 in November and December. For Asia, from our perspective, it doesn't necessarily mean that central banks are going to be cutting rates very quickly in this region. In fact, our economists believe that central banks are going to be fairly gradual in terms of their approach to easing policy rates in Asia. We do have already a lot priced in for a number of central banks in this region. So I guess the risk is if the Fed goes 50, we may see more aggressive easing in this region. For Asian currencies, we still think they're fairly defensive in this environment. We've had, if you look at the biggest outperformers this month in currencies in EM, it's really Asia at the top. It's the likes of Thai baht, Malaysian ringgit, Indonesian rupiah. It's the Southeast Asian currencies that have done well. We don't see any major turn in that at the moment, although we may see a little bit of consolidation in the short term.
Of course, and it also comes down to what exactly is priced into the dollar already, which, while sitting around the 101 mark at one point, I think on Friday it got down to the 100s. Do you think that the US dollar is now, at least for the medium term, in a confirmed downward trend?
Well, we've had a generally constructive view on the dollar for some time, and reality is obviously that's come under a lot of pressure recently. We haven't backed away from that yet. Our view has been that ultimately US growth outperformance, productivity gains, asset market returns, relative output gaps, and a number of other factors, including weak China and European growth, all are generally supportive for the dollar over the medium term structurally. So we still think that holds. Clearly, we're at a different starting point with the dollar decline that we've seen in the last couple of months. And of course, if the US economy does move into a harder landing, things could change as well. But look, if we're right about a soft landing in the US and we still see weakness elsewhere, it's really hard to keep on selling the dollar, especially given how stretched negatively positioning and sentiment is for the US dollar at present.